Good day to all. This is our second part involving discussions of cash conversion, receivables, and inventory management, or simply known as working capital management involving current assets and current liabilities. And now we are to proceed for accounts receivable. Please watch our first part or part one discussing cash conversion cycle with operating cycle, our inventory management. For accounts receivable, this will be also unique in that we are going to talk about the credit department's job or responsibility, or even a credit staff in a certain company for products, either goods or services that are offered on credit or on account or terms. So if a company decides to offer trade credit, it must, here are the steps: determine its credit standards. What are the respective criteria that normally we look into the credit? Next would be set the credit terms. Terms could not just involve with a period, but also with the conditions attached and all the agreements involved involving the respective policy or credit terms, or let's say the contract. Next is develop collection policy. So how many days should a company collect? Who will collect? If ever we cannot collect, what can happen and all. And finally, monitor its accounts receivable on both individual and aggregate basis. If we are going to look into aging of receivables in our financial accounting and reporting, in which this is the most preferable, and actually this is really in accordance to our international financial reporting standards, that we are going to group our respective accounts receivable in terms of their outstanding credit periods, like example from 1 day to 30 days, 31 to 60 days, so 30 days interval, for example. And then we also call that as the matrix approach. So we look into the individual, but also we look into the aggregate, because that would result to also the recognition of bad debts, and also known as uncollectible accounts or doubtful accounts expense. Now, for credit standards, these would involve application of techniques to determine which customers should receive credit. Then in that, we are going to look into the internal and external sources to gather information relevant to the decision to extend credit to our specific customers. So that's explanatory. And then this one is for variable costs to be considered only for products sold on credit, because these are the differential and these are the incremental costs that would vary should we extend our respective sales into credit terms. Unlike for fixed costs, wherein no matter what we do, they remain fixed. They would not change depending on any decision. Then in that, we look into the credit selection techniques, a review of 5 C's of credit from our discussions of other financial management subjects, especially the basic finance and credit scoring. But we are not going to really do this like to do the scoring and all, because they are to be tackled in other financial management subjects or courses. Next, what are the 5 C's of credit that we'll have to look into, especially for high dollar or peso credit requests? So these are the following, the 5 C's. Character, which would mean the applicant's record of meeting past obligations. Well, that can be seen on any existing credit that they've had. So did they pay on time and all? And then also the desire to repay debt if able to do so. So not just the actual, but also even the desire. Then capacity is all about ability to repay the requested credit, like capacity for the repaying of that. Then capital is all about the ownership of the applicant, so all assets applicable. Then collateral will also be what assets are available in order to support the credit. For capital, that's the financial strength, but collateral is really the available assets. Then capital, remember, is assets minus liabilities. So what is left when we pay the liabilities? And finally, conditions would be what would remain, or what are the conditions there, what are the situations beyond and not just on the four, so other than the four, in other words. So in other words, also we can say that conditions are situations that are not found on the first four factors or four components of credit, or the 5 C's of credit. And this refers to current general and industry specific economic conditions like the inflation rates, the levels of unemployment, and etc. Then credit scoring is all about providing weights which are statistically derived for credit or key credit characteristics to determine the credit score. And by credit scoring, we will be able to assess if ever this particular applicant or prospective client or customer can pass our standards. So this is also used with high volume or small dollar credit requests, even as mentioned with the 5 C's, the high dollar or high volume. But for credit scoring, we can also do this one. This is most commonly used by large credit card operations such as banks, oil companies, and department stores. Here is an example. Let's say WEG Oil uses credit scoring to make credit decisions. And then WEG Oil decision rule is if a credit score is greater than 75, so we extend the standard credit terms. If the credit score is less than 75 but greater than 65, so we extend the limited credit. However, in the event that the account is properly maintained, so we convert that to standard credit terms after 1 year. And finally, if the credit score is less than 65, so we are going to reject the application. What about if equal to 65? So I suppose it is on the second, extend limited credit. Okay, to continue. So example are as follows. We have the credit application, and then we have the score from 0 to 100 of the following characteristics as shown. And then here are the predetermined weight for each to total 1 or 100%. And if we are going to multiply 1 with 1, which means score, and 2 the predetermined weight, we get the weighted score, and we get the total weighted score that is with the highest also of 100%. By this one, 83.25%, this means that we are going to extend the credit to our applicant. So this is the standard of the company. In fact, it is really higher than 75 a while ago. That's 83.25%, or 83.25 points. So action is to extend standard credit terms, and then as seen here, similar to what we've said a while ago. Now, what about if we change our credit standards? Is that okay? Yes. We relax normally if we want higher sales, we want higher profits, if positive contribution margin. However, we have to take note that the more sales there are, the more accounts receivable, the more costs of keeping such, the more costs perhaps on the respective cost to be spent on collection, and additional chances for bad debt expense, and additional chances later on for accounts to be written off because they can no longer be collected. Then what about we tighten the credit standards? We normally do this if we have many accounts receivable, many cases of bad debts, and of course, many accounts written off. So we reduce investment in accounts receivable, lower the bad debt. However, in that case, we also lower the sales and profit. So here's an example. To evaluate the effects of a relaxation of credit standards, we have YMC sells CD organizers for $20 per unit. Then all sales are on credit. This is very important sentence because we have to segregate cash with credit. And then the company expects to sell 120,000 units next year. We also have to take note the variable cost, which is $12 per unit, because we've said a while ago that this is the focus. Fixed costs would remain constant regardless of the decisions that we make, unless that's another avoidable fixed cost, which is quite, of course, going to change between alternatives. But if silent, fixed costs will ignore. Then the change in credit standards will result in 5% increase in sales. Let me minimize this so you cannot see. Average collection period will increase from 30 to 45 days because of what we did. And then this is relaxation for sure because there is an increase in sales. And then there's also an increase in bad debt from 1% to 2%. Our collection would also increase in terms of period. The costs are not mentioned anyhow, but the period because we have more sales. Okay. Then what is the additional profit contribution from sales? Going back to our given, there's a 5% increase in sales. If we multiply that with 120,000 times 5%, we get 6,000. And then our price is $20 and then variable cost is $12 per unit each. So we get a marginal profit from increased sales of 48,000. So when we analyze, we look at the margin. Then the cost of the marginal investment in accounts receivables would be the additional investment times the required return. To compute, we have our average investment in accounts receivable is total variable cost of annual sales, escape that, divided by the turnover of accounts receivable. For the turnover, we have to take note that the formula is our sales or annual credit sales divided by our average accounts receivable. And then if we have our ACP, so we can, of course, work back if we would like to. Okay, so that is what we are going to do by then. Is it even though? We have the average collection period here, and then, so 365 divided by 45, that's 8.111 dot. So we take note of that. And then whatever is our annual sales cost, our turnover, by the way, is 8.111 dot dot dot. So use everything. Total variable cost of our sales from this. Take note, this is additional investment. So we look into the 5% increase of sales. So that's 6,000 times the $12 per unit. So that's 72,000. So 72,000 divided by that, that's 8,876.71. That's our additional investment or cost of the marginal investment in accounts receivables. Then number 3 is our cost of marginal bad debt expense. So for that, we are going to compare the old and the new. So the old, let's begin. We have sales current of 2,400,000 times 1%, that's 24,000. The proposed, remember, our sales will increase by 5%. So 2,400,000 times 1.05, that's 2,520,000 times 2% is 50,400. So 50,400 minus 24,000, that's 26,400. That's the additional cost of the marginal bad debt expense. Well, the net profit for our consideration would be, as explained a while ago, marginal profit from increased sales. We've done that from number 1. Next, cost of marginal, I've explained that a while ago. And for number 3, so that the net profit would be $13,364. So in that case, normally we will accept the credit decision. So here it is for our total variable cost of annual sales, the computation. So that's how we got our answers a while ago. Okay, so we have here, well, a while ago, what we did was a shortcut, but this is the actual computation that would really result to the actual answer because we have like a rounding of difference. So we just have to follow this one. We get the total variable cost of current and proposed. Then after that, using the formula of turnover, which is 365 over ACP. ACP, by the way, is also known as day sales outstanding. So we get the respective turnover of AR for current and proposed. What is did by the author here is that it is rounded in terms of our turnover. But I would suggest if we compute later on, we do not round off so that we can really have the same answers or final answers. So after we get our total accounts receivable turnover for current and proposed, so we would be able to get by, let me go back, again, turnover. Then if we use that for our respective computation of turnover, which is annual sales or the annual credit sales, both current and proposed, divided by the turnover for each. So we would be able to get our average accounts receivable or investment and accounts receivable for each. And then if we deduct the two, that's going to be the additional investment for the two. And required return, let's say, is 12%. That will be our cost of marginal investment in accounts receivable. Okay, so that's how we got the answer. Then another one is credit monitoring, wherein monitoring would involve continuous and ongoing review of a firm's accounts receivable to determine if customers are paying according to stated credit terms, if the period and all conditions are followed. Then for that, we can do the following: the ACP method, the aging of accounts receivable, in which the two have been mentioned, and payment pattern monitoring. So ACP normally is the average number of days credit sales are outstanding. So we've said that the period it takes for us to collect our respective credit sales. And then we can use this formula, accounts receivable over average sales per day, in which average sales per day is the sales, credit sales, divided by 365. But then we've already mentioned also a while ago and a lot of times about using our turnover formula. And then next would be the ACP formula. Okay. For aging of accounts receivable, we will be able to see the respective outstanding days and the outstanding value of the AR balances and the percentages that they compose to our accounts receivable, plus the data like what percent or percentages, or let's say the compositions in which of those respective components of total accounts receivable, what percentages that they are uncollectible. Then credit monitoring, we can see also through the payment patterns, the normal timing within which a firm's customers pay their accounts. So we look into the percentage of monthly sales collected following and should be constant over time. If there are changes, then firm should review its credit policies. As an example, DJM Manufacturing determined that 10% of sales collected in the month of sales, 60% in the next month, and 30% 2 months after the sale. So it's like the 10% is sort of down payment because it is within the month. Then can use payment pattern to construct cash receipts from the cash budget. If January sales are 200,000, following the percentages, remember 10% in that month. So in the month of January, that would be 20,000. 60% of 200,000 in February, we have 120,000 in that month again, and 30% of our 200,000, that's 60,000 in the month of March. Then this is the sample aging for accounts receivable, wherein again, we can see the age of the accounts, the total accounts receivable for each component, also showing the total of the totals, and the percentages of such to the component. Also, we can see in some illustrations the percentages of each that we estimated them as uncollectible. Then forecasted collections for DGM manufacturing using payment pattern monitoring, using again the data for what percent that can be collected in the first month, 10%, next month 60%, and the next month would be 30%. And we can see the total projection for the collections or total projected collections for cash budget of the months. And finally, we just have to take note of the following. So the length of cash conversion cycle determines the amount of resources the firm must invest in its operations. Normally, the positive and the bigger positive that it becomes, therefore, we need more investment to cover up our operations. But if it goes lower or it gets lower and there is lowering down up to the point that it gets negative and very substantial negative, which is the better because the payment period is now greater than the others. So really there is a big stretch of the payment obligations without additional interests or charges or penalties, then that is much better. And the company can make use of whatever cash there is. Then we have to take note again of cost trade-offs about the cost one and the cost two, one that would be resulting to marginal cost and cost to marginal benefits of all our working capital components. So cash, marketable securities, accounts receivable, inventory, and AP. And then our goal for inventory management is really to optimize the amount of inventory such that we get the EOQ using the formula, and we can see it using the graph that it is the point at which the carrying costs and ordering costs are equal. Then the accounts receivables objective is to collect accounts as quickly as possible so that the company will have cash, but then without sacrificing the sales. All right. Thank you very much for listening to our part two. Hopefully you get something from this session, and God bless.